Gautam Chachoria, Head of India Small Cap Mid Cap Research with UBS, joins us. Gautam, always a delight to have you back on ET Now. Thank you for joining us. Let's start with something which is bothering markets. JLR sales numbers. What do you make of that?
Good morning. I think it's clearly below trend, and if you look at the absolute numbers, it's not necessarily bad, and you always have some seasonality, etc. But it's also, when you look at the stock price, etc., I think our view is that market was extrapolating strong growth trends to continue into this fiscal, and I think it's more about expectations. Expectations were running very, very high, and in this kind of business, you'll always have small hiccups. So absolute numbers were not necessarily that bad, but in terms of what expectations were running at, it's a big disappointment.
So at 272, is Tata Motors a good stock to buy? Because what will bail out the stock eventually is valuations. If I look at P multiples of what the Bloomberg consensus is, Tata Motors for FY13 is trading at what, about 6-7 times?
Yeah. So we actually have a sell rating on Tata Motors, and on the same basis as I just said, that expectations are running very, very high for the stock in terms of volume growth. So JLR will continue to do well. I don't think you'll see JLR having a negative growth year or as such, but in terms of what the stock was expecting, in terms of the P multiple which you are saying, which reflects the kind of earnings growth the market is looking at, that seems a bit high. The second thing there is, we've been highlighting this, that if you look at P multiples, etc., for Tata Motors versus a lot of the global peers like Audi and BMW, one differential is the accounting of the R&D which they do for JLR. So it's much more capitalized for Tata Motors versus the other two. So the P number sometimes can become misleading.
Gautam, what about your tactical, investment strategy? Are you still bullish on names from the pharma and consumer sectors, given the kind of market environment we're in?
So we actually have a negative view for the Indian markets for next quarter or two, and and in that context we are recommending a much more defensive portfolio. In fact, we are also recommending 10% weightage for cash because we think that you will get better buying opportunities over the next couple of quarters. And in the context of a defensive portfolio, obviously consumers and pharma do stand out in terms of being defensive. Now these stocks have done well; they're not cheap. But just to highlight, if you look at consumer staples or even discretionary names over last couple of quarters, and including the few numbers we've seen for the March quarter, last 2-3 quarters has been one of the toughest macro environment for India locally. And these companies, they have faced pressure, but if you look at the absolute numbers, they've been quite positive. So when you look at the earnings visibility over the next couple of years, you still feel reassured that they'll come out in terms of still delivering earnings growth and quality earnings growth. So even though valuations are expensive, they are not super expensive where they're trading at 2 standard deviation above historical averages. So they are in a slight premium to historical averages. So we're still comfortable in absolute terms. And from a defensive portfolio context, obviously it makes sense to be in those names.
Gautam, you've just come back from a 2-week roadshow from Europe and from US. So what are the kind of sound bites you've picked up from some of the global investors? Are they re-looking at entering India at these levels? Because if you enter India now, you also could get a currency advantage, because if rupee appreciates, then that's the advantage for global investors.
Yeah. Look, I'll summarize by saying that I think the universal view is still negative about India, but I think people in Mumbai are much more bearish about India than globally. So they are global investors in US, Europe. They are frustrated and disappointed with what's happened in India over last year or so, but they're not in a capitulation mode where they want to get out. So they are still exploring as to when, what to buy and when to buy. In terms of near-term sentiment, I think near-term sentiment driver will continue to be global macro, which is Greece and Europe, rather than India-specific factors. What can be a trigger for them to come into India in the short term will be crude, but medium term they will be looking for sound bites from India itself, especially on the investment cycle front, to come back to India in a bigger way. But yeah, few investors are willing to look at constructively, but not in the next couple of months. That's
an important message, isn't it, Gautam? At a time when the local fiscal situation is in a mess, earnings have been just about okay. The message you've come back with is that global investors are not looking at selling India. In fact, they want to buy Indian equities at low levels.
At lower levels, yes. But when I say they're not looking to sell, the important point to remember is that a lot of the global fund managers are already neutral to underweight India. There are very, very few investors. In fact, I didn't find any in Europe and US who were overweight India. So they're already neutral to underweight India. And you have to remember one basic fact from a global fund manager perspective, especially the global funds or the GEM funds or even Asia funds. It's very difficult for them to have a zero weight in India. So when you hear of all these statements that they will sell and get out of India, that's a real extreme statement. Because if you look at their mandates, they can't run the risk of having a zero weight India. And just 2 points to highlight from that perspective. You saw a lot of fund managers highlighted as to what they experienced in January, February, early part of this year, when India had a sharp rally because of currency, etc. And they faced underperformance because of that, because they were underweight India. And secondly, just to slightly take a medium-term perspective, the key point to highlight is what we are seeing right now is a reset of growth expectations. But once we have a reset of growth expectations where we realign ourselves in terms of economy, in terms of market, in terms of earnings to lower GDP growth trajectory, we'll still have GDP growing at worst case 6.5%, 6% maybe, and you'll still have double-digit earnings growth, which will stand out in the global context. But this reset period which we are undergoing right now, that will take time. It will take about a quarter or two, and then possibly will stabilize and give more comfort to investors to come in.
So Gautam, let's talk about this pockets that you do like, which is defensives, pure pharma as well as consumer names. What is it that you're recommending buying into, or for that matter holding at this current juncture?
Okay. So again, this is a model portfolio construction. So we are recommending names like ITC in Colgate and Staples, Dr. Reddy's in pharma, but we're also focusing a lot more on bottom-up ideas, even in sectors where we are underweight. For example, banks we are underweight, but we are recommending ICICI Bank and Federal Bank. We are neutral in autos, but we are bullish the two-wheeler space, and we are recommending Hero Motors and even Mahindra over the medium term. So it also boils down to stock-specific views rather than just sectors. Sectorally, again, we do prefer to be in consumer staples, pharma, and the defensive power utilities like NTPC and Power Grid.
You've also got a sell, Gautam, on Jubilant Foodworks, and you sense it is not because of the valuation, which is the bigger concern for the rest of the market men, but because of increased and aggressive competition from another leading national player. If you could elaborate a little bit more on your rationale.
Sure. So again, valuation is the key. So when if you're buying the stock at a particular price and you want to make money after buying the stock at a particular price, so they are a great business, fantastic franchise, fantastic management. But buying at this price, what is the upside you can look at from a year, 2 year perspective? That's where we have a disconnect. And two big issues there is obviously one is competition. And competition is important to highlight because the last 5 years they've done phenomenally well, but there was literally no competition from either a national level branded delivery pizza format or even from non-pizza chains. So you didn't have any Indian cuisine national chain or a Chinese cuisine national chain in the mass market format, which we are seeing signs of changing. So we've already seen Yum brands having a more aggressive approach to launch Pizza Hut delivery format in India. You are seeing a lot of private equity investments happening in mass market Indian curry chains, etc. So you will see a lot more competition for a growing customer wallet, but there will be more players around. So when you're paying a 45 times, 50 times PE multiple for the stock, when you have these emerging concerns, so the comfort level of buying at this price and making money is far lesser than, say, buying at 30 times PE multiple.
Gautam, I'll take my chances with this one. Have you looked at the specialty restaurant IPO which opens today? We can't comment on any forthcoming IPO. We are restricted on that. Okay. Let me now pick up the odd ones out from the mid-cap portfolio. Zydus Wellness, and you've got a buy on Carborundum Universal. Now these are indeed the odd ones out. Mid-cap stocks, illiquid in nature. What makes you bullish on both of them?
Look, if you look at the mid-cap space in general, and the two ways to look at mid-caps, one is the classical approach of looking at mid-caps as highly leveraged, high beta names, which you typically play in terms of view of the market. So you buy those names when you're expecting markets to do well. The other way to look at is more what we try to do in UBS and what actually is much more relevant from the Indian market point of view is look at long-term business models which have, and these are typically also market leaders. If you look at Carborundum, they are a market leader in industrial materials in India and emerging as a very strong player even globally. Same for Zydus in the wellness space where they are present. They are the market leaders, which holds true for a lot of the mid-cap names which we cover. They are market leaders, strong businesses, strong models, which will hold true, hold ground even through a weak macro environment, which you've seen for a lot of names over the last 1 year also.